At what point do investors need to start worrying about the possibility of default? We're joined now by Mark Dow, portfolio manager for Pharo Management, also a former economist at the Treasury Department and International Monetary Fund. And we have Nicholas Colas. He is the chief market strategist, ConvergEx Group. Gentlemen, good to have you with us. Mark Dow, let me begin by you. Should we panic now and avoid the rush?
Panicking is de rigueur in the markets. I think the bottom line is that this will get done. It's just about how scared we get before that happens, and then what the quality of the agreement is. As we get closer to it and the probability of an agreement becomes higher, people will start to focus on the quality of it. But expect a lot of headlines between now and then, and a lot of things for us to overreact to.
Nicholas, do you agree?
Absolutely. We are going to face a torrent of headlines over the next couple of weeks talking about how the agreement's almost there and then going to break down, then almost there again, and then going to break down. We're in for something that I think goes all the way to August 2nd, for sure.
All the way to August 2nd. This coming after the Moody's report last night that they are putting the AAA credit rating of the United States on watch for a possible downgrade.
Yes, even with headlines like that, there is still a desire in Washington to craft a political settlement, and that always takes more time than it should.
Mark Dow, do the legislators in Washington, as well as administration officials, do they not see the same headlines that we all see?
Yeah, they do, but the game is a little bit different at their level. I mean, a lot of these guys just came into power, just came into office, and they have certain promises to keep. And then a lot of people at the party level, both parties, are thinking about how to position themselves for the coming elections. Each party wants to establish the moral high ground going into the next elections, but they don't want too many fingerprints on things that can be used against them, details in those elections. So it's a very delicate balance, and it's a little bit like jiu-jitsu, right? Whoever has the upper hand can change very quickly.
Well, I like this idea of balance because that makes me think of the actual composition of the debt. We're talking about really borrowing from ourselves. And when you look at the composition of the debt, let's say it's $14 trillion in round numbers. About $9 trillion of that is actually held by investors, foreign, U.S., corporations, right, individual investors. But $5 trillion of that is non-marketable. Those are Treasury securities that are held by the Social Security Trust Fund, the Medicare Trust Fund, the Federal Housing Authority. Does it make any sense to be arguing about a debt ceiling when $5 trillion of the $14 trillion is actually held by the same federal government that we're arguing about?
Yeah, that's the hard part of the equation to always think about. The piece to focus on is that $9 trillion, the piece that does have to go to market, the piece that does require confidence from not only domestic investors, but international investors as well. So there is a component that we do have to worry about what the optics look like and what the next negotiation is going to look like after this one.
Mark Dow, how much is it costing the United States in order to fund this debt? Some estimates are about $120 billion a year. Yep. If there is any kind of default or interruption in payment, what's that going to do to interest rates and the future cost of funding that debt? We don't know.
And the honest answer is we don't know. But things can get nonlinear very quickly, particularly given the backdrop that we have in Europe. And
what does nonlinear mean in sort of normal talk? This just means that things can go from 100 to 0
very quickly
overnight.
Things go very fast, move very fast. I mean, it's really all about behavior and about confidence. And there are many different paths. We live in a world of multiple equilibria. And the bigger picture, if you step back for a second, is that the developed economies are having a lot of problems. Their growth rates are slower, their debt burdens are high, the promises that they've made to their constituents are significant. The emerging world, on the other hand, is growing better and has better balance sheets. We're seeing kind of a role reversal. And against that backdrop, people are getting increasingly nervous about the developed economy debts. We don't want to give them anything that makes them even more worried than they already are, and this is why we have to be extra careful with this.
Nicholas, it doesn't seem as though the markets, whether they're the fixed income markets or indeed the equity markets, they're seemingly shrugging this all off, whether there's an August 2nd deadline or not.
It is the great irony of capital markets right now that the 10-year can be below 3% and indicating very little, if any, worry about what's going to happen with the federal debt limits. The most you can say is that sectors in the stock market have traded with too much closeness over the course of the past 30 or 60 days, really signaling that it's an all-or-nothing trade in the equity markets, and that erodes confidence over the medium and long term, because obviously different sectors should work at different parts of the economic cycle, and we're not getting that right now. So it does have some harmful second-order effects, but as far as first-order effects, it's very hard to see where they are.
Nicholas, we were just talking during the break about who owns Treasury debt. I mean, as you described, you go to business school, you find out that the risk-free trade is you buy Treasuries. That's the risk-free trade and the risk-free rate. Is it possible that everyone's going to have to go back and take a new course in business school now?
That's really existentially what makes this conversation so difficult for us to all consider what it means. Because as you said, the first day you walk into B school, they teach you the risk-free rate is the Treasury curve, and everything builds off of that. Notions of risk, notions of collateral, notions of capital are all baselined around that notion. So something as simple, if you want to trade options and futures in the U.S., you post collateral. That collateral is Treasuries. If you want to own a safe mutual fund, money market fund, what do you own? You own Treasuries. The minute you begin to unwork the notion that they're not risk-free, you have to go back to the drawing board about what really is.
Well, let's pick up on that, Mark Dow, because are there specific institutions which are not, by law, by their own covenants rather, not allowed to own anything other than AAA rated debt?
Two things. One, there are a lot of institutions that can't hold things below AAA, and more importantly, the capital that you have to set aside for against your assets will depend on its rating. So you may have to capital requirements will go up for a lot of people, and that's meaningful. It's a contractionary effect. We don't know how large it is, but conceivably could be quite strong.
So is it possible that we somehow get a late agreement, August the 2nd at midnight, they raise the debt ceiling, but Moody's, Fitch, Standard & Poor's, they go ahead and they do something to the AAA credit rating? Because you can still pay your debts and not have a AAA credit rating.
Probably not. Probably not. It looks all the signaling from the rating agencies is that if the agreement is less than satisfactory, but there is an agreement, they will put them on kind of a negative outlook or put them on double secret probation, right?
Oh, I like that.
So,
double secret probation.
Right.
Yeah.
So to borrow a phrase from the movie Animal House, and then see how things evolve from there. If they don't get an agreement, obviously the likelihood of an immediate downgrade is high. So I think that's where they're shaking out. They want to fire a warning shot, and they have, and they'll fire a second warning shot if they get agreement that's not quite satisfactory. But I don't think they would move to an outright downgrade.
Well, you've both said that we're going to get a drip or a constant drumbeat of headlines leading up to August 2nd. Are we also going to get headlines that various funds and various banks are going to try to square their positions, pull out of various instruments ahead of August 2nd? Because let's say there's no agreement a week from now. Is everybody going to try to rush to some kind of exit, or are they going to try to lower their potential risk?
The hard thing about this trade is there's no place to go. That's the bottom line. Treasuries are so ubiquitous, as we talked about, in every market around the world. It's very hard to know where to go. There's no other capital market as deep and as broad as the ones offered by the U.S. capital markets. So they can talk about it, but it's very hard to know where they'd go.
Mark Dow, last question to you. I know we've created this problem ourselves. Can we really create the solution in the next couple of weeks?
I think so. I mean, I think the odds of an agreement are quite high. The question is really about the path and how scared we get before we get to that final agreement. And always there's always a chance that things slip and we don't get an agreement, and that's what keeps us on our toes. But for fixing the broader debt problems, it's probably not the appropriate forum. You don't want to do it over the weekend with a gun to your head. You want to do it in the fora that were designed for it over a longer period of time. But the good news, and people get very bearish on the fiscal outlook in the U.S. with good reason, is that over the next 14 months we're going to be debating the fiscal position. And whoever gets elected in the next presidential elections will be the person who convinced the American people that he or she can handle the fiscal problem, and that person will have a mandate. And I'm guessing that the next 14 months will be spent educating us on a lot of the issues and helping us get into a position where we'll be willing to take a little bit more pain and sacrifice.
Well, of course, I hope that both of you will sort of tutor us along the way. I want to thank you very much, Mark Dow, Pharo Management, Nicholas Colas, coming to us from ConvergEx.